Devina Mehra joins in on the show right now. Devina, hi, morning. And what a day it's turning out to be, or last 2 days, I should say. Thank God for that one day respite yesterday for us, at least, with Devina. But what is the market getting so spooked about? You think this is just positioning ahead of the budget?
Hi, Aisha. So, I mean, there are obviously budget is does bring uncertainty, but I suppose it is also the recent news on Adani Group, which has also spooked the market, as what you are saying, and that has an impact beyond just the group. I think you guys were just discussing it, and that becomes an overhang on banks also, because the banks, the whole story has been that the NPA cycle is kind of behind us. But as I always say, even though right now we are market weight to overweight on slightly overweight on banks, that I am fundamentally never very comfortable with banks. I think the last interview with you also had said the same thing, that I am always scared of negative surprises in banks. Having been a banker, I know negative surprises hide somewhere, and as an outsider, there is no way you can make a judgment on where those negative surprises can come from. But then it is the highest weight in the index. That's also a reality.
As a market expert, if you have to analyze the sell-off in Adani group of stocks because of a report, a third-party report, do you think the market reaction is overdone?
It's not a group that we follow very closely. Um, so I would not like to really comment on it, but I mean it is a fairly detailed report with a lot of facts and figures. So I hope the Adani Group refutes it with equal rigor in terms of the particular things they have said, rather than just a blanket rebuttal.
Okay. Uh, the selling in bank also could be a factor as to Adani group of companies have exposure to banks. The debt of Adani group of companies has come down, I think, on Tuesday and Wednesday. Is that worry as to what will happen to the debt and what will happen to the banking system? Typically, these concerns they start. Is that fear, at least for banks, is overdone?
Yes, I mean, as of now, it does appear a little overdone. In the sense, I mean, I don't see any impending collapse of this credit. As I said, that's a more generic thing, that in banks, there are always some negative surprises hiding. But the fact also is that a lot of last few years, a lot of those NPAs have been recognized, they've been provisioned for. So now that cycle had turned for the better. So to that extent, I would think that this is a little more of a knee-jerk reaction. How much the banks have fallen, and many of them may not even have exposure to that group, that particular group in any case.
Okay, so that's Devina Mehra and what she's saying when it comes to the Adani group of stocks. Remember, the FPO subscription also opening today. In the run up to that, we of course did see the third party report that had come in. Devina, of course, what we've been seeing is maybe the domestic investors, who the Central Exchequer herself likes to call shock absorbers, wait and watch for 1st of February, something you've touched upon. And we've seen how FIIs have also started selling India from the start of this year. Can anything be done? And I'm actually going to ask you this on 1st of February to make them net buyers again. Or this is also, allocations that happen per region. Just break it down for our viewers.
Okay, I mean, as I've said plenty of times on your show, that I don't track FII buying or selling, because it actually, data shows it has really no correlation with market movement. So it's a waste of my time to do that. And as far as the budget is concerned, uh, I am not one of those market people who think that the budget should have something for the market, quote unquote, uh, uh, because I don't think that is or should be the major focus for the government. Uh, I mean, I don't want an increase in capital gains tax, but having said that, I think the focus for the government should be on more longer term issues, particularly education, health, and employment. And education and health also tie into employability of people a few years hence. Employment, to my mind, is the biggest worry for me as far as the Indian economy is concerned, because we have not been doing well on that at all. Even pre-pandemic, we were at 40-year high on unemployment, and we all talk of demographic dividend, but the demographic dividend actually has three components. One is how many people are out of the total population, how many are of working age. The second is how many of them are actually working, what percentage are actually working. And the third is the productivity. We have the first, which is there for a limited period of time. We've already seen, for example, China, the population has started to decline, and we'll also get there after a few decades. We have the first, but we are not able to get the working age population actually working. So that's a big gap. And that also shows in the fact that 80 crore Indians require free food. That shows you that the economy as a whole is not doing that well at all levels. And only when you get employment will you also get the businesses growing, and therefore the stock market growing on a longer term basis, because that's where the manufacturing and services output comes from. And that's where, when people are on wage, are earning wages and salaries, they go out and spend. So that's the virtuous cycle we have to aim for, and that should be the focus.
Devina, at the start of this interview, you also said that one has to watch out for the negative surprises. Very often, the fine print is, of course, in the in the details that come out. I still remember that was the case with the retro tax as well. It was never part of Pranab Mukherjee's speech. But having said that, I want to come back to banks. Now, we know SBI is, of course, in your top holdings, as is ICICI Bank. Now, this earnings season, what we have also seen, of course, is the other private sector lenders come out with good numbers. We've seen a run up in the smaller public sector banks' valuations as well. What I'm trying to get at is has the time come for you, maybe, to, when you look at your top holdings, to give more weightage to an HDFC Bank, which Elephant has started dancing? People are now talking about Axis and Kotak also playing catch up.
Yeah, so I mean, this time we have done a bit of a rejig. We do a ground up rebalance every quarter. So in our January rebalance, these numbers are as of December end, not as because that's the last fact sheet. So there has been a rejig, and we have done some of these reallocations that you were mentioning as a possibility. Yes, we have reduced weight in some of these and put it elsewhere in banks.
Devina, hi, morning. Wanted to also understand your outlook on ITC as well. Given the kind of run-up that we've seen in the stock over the last 1 year, now the company's focus as well on the FMCG business being the main growth engine for the company. What's your outlook as to what investors should do right now?
In fact, ITC was, I think, our #2 winner for last year. So we got into ITC pretty early in the game. In fact, that was the first FMCG stock that we bought um, early last year. And we continue to hold it. I mean, that was such a dog for so long. So when that turn came, we got in fortunately at the right time. So we continue to hold that, so that that bet still continues.
Enough. That's the view coming in on ITC. What about your view on, some of the other capital goods, infrastructure stocks? I see the likes of SKF, Cummins India, and, something like a Timken as well. Just walk us through, your views on what could emerge as strong contenders in the long run within the mid-cap arena.
So capital goods, industrial machinery, again, we went quite overweight now, almost a year and a half, from October 2021. So almost a year and a half. And that's been, again, a big winner, and including, I think, almost all the names that you mentioned, we either holding or have held in the past. Now we have started to lighten up a bit, simply because, there's been a lot of profit in that. So we've been booking some of those profits, and so in this rebalance, we would have reduced the weightage a bit, but we would still be quite a bit overweight still. So that sector, from 2009 right up to 2021, it was a dog sector over a very long time. I mean, that I think it compounded some 2% as against the market compounding some 10%. And fundamentally also those were not doing well. So once that turn came in the business, and also that the after that underperformance, it went into outperformance territory, that was going to last a long time. And also the other thing was that because it was a dog sector for so long, most companies cut costs, became much more efficient. So when the business picked up, you actually saw it in numbers. So I said it continues to be our most overweight sector still, but we have cut down from where we were by booking profits in quite a few places. So, I mean, that's the position as of now.
Devina, in your multi-asset allocation portfolio, I see gilts and gold right up there. I don't know what's the, order of hierarchy here, but why gold? Yes, it is sitting at an all-time high, but do you think this is also some indication on that the world is going to continue to, find cover under the safe haven gold?
See, the multi-asset portfolio, the whole logic is that it has to be equity plus plus to reduce the equity volatility, and it has delivered on that. So that is why, normally, and in India there are not a whole lot of other assets. Like if I go to our global multi-asset portfolio, there are many things to buy. Even in terms of commodities, there are a whole lot of things that you can buy. And also you have things like REITs and all that. But in India, it is pretty much either fixed income and gold, and we are often not comfortable taking credit risks. So that's why we normally go to gilts. And because the whole purpose is to reduce volatility. So I would rather not have too much of a credit risk there. And gold, we always hold some. We have increased allocation slightly now because the gold is looking better than it used to, and it has done well of late, as you mentioned. So that is the position.
Devina, but are we in for one of those years where one is better off, let's say, giving equity an underweight positioning, whether it is at an asset allocation level or whether it is in terms of a thematic level? Uh, the shape of the world is not great. 3 months ago, we were debating inflation. Now we are debating recession. God knows what we will debate after 3 months. It's so fluid that equities generally do not do well when valuations are rich or valuations are high and the environment is unpredictable.
Okay, so inflation, when we were discussing inflation, I had said that recession is definitely on the cards as far as, US and some of the other developed countries are concerned, because all the indicators were showing that. And when you are raising rates at that rate, anyway, it is definitely a likely outcome. Now, the only thing in all of this is that how much of it is in the price. So if um, I I think I gave the statistic in my last interview also, that last year was about the worst year globally for almost all asset classes. Worst year, even if you take a view of a century, as long as that, or for that matter, US bond market, it was the worst year in 230 years, meaning from when records start. In equity, both bonds and stocks being down significantly happened once during the Great Depression in 1931, once during the Second World War in 1941, once in 1969, and then 2022. And not just the US, if you look at all geographies, all asset classes, everything was in the red. Everything was in the red. Only two exceptions being, even within commodities, the precious metals and industrial metals had a boom and bust. So net for the year, only thing which was up was energy and a few agri commodities. That's it. That's it. So this is absolutely outlier year. Now, when you have such a disastrous year, the probability is high that the next year is going to be an up year. I mean, obviously, improbable doesn't mean impossible, but overall, the world asset classes, and particularly equities, are more likely than not to have an up year, because that's what the data shows. This kind of year doesn't repeat. Now, within equities, yes, there might be some change in leadership. So our view right now is that the leadership to some extent has moved from the US to Europe and some of the emerging markets, India included. So India, Mexico, Brazil, and so on. But we are just watching to see whether that's like a more shorter term change in leadership or whether that's going to be a multi-year thing like what happened in 2003 to 2007 when emerging markets went up 3.5, 4 times and US could not come out of even its tech crash lows. So that is something to be seen. But overall, equities appear like a good asset class. Number one. Number two, India continues in the outperformance bucket. So I don't see big risks here. And of course, I'm always in the asset allocation camp saying that you should not put 100% in equities, even if you are young, because you might need some money later. And obviously, with interest rates going up, even fixed deposits will become more attractive. So have an asset allocation attitude, yes, but I don't see outsized risks in equities just now. And also, okay, you talked of uncertainty. Let me just add to that as well. That sentiment is a contraindicator. So when there is uncertainty, when people think things are going wrong, the next period returns are above average. When people are all gung-ho, the next period returns are below average. And this is academic research across the world, not just in US or not just in one or two countries, but every single country they have tested this, they have found the same thing, whether it's Portugal or Brazil or whatever. That sentiment is a contraindicator. So that itself also shows what you should be doing. If you go to 2021, everybody wanted to get onto the Nasdaq bandwagon. When Nasdaq fell 40%, then everybody wanted to get out. So you just compound your bad decisions by just going with the flow and how everybody is feeling.
That's why own research is so important, right? And not to have that herd mentality. But Devina Mehra, it's always a pleasure talking to you. Thank you so much for joining us just a few days ahead of Union Budget, giving us your views. It's an event this time round, unlike maybe last year and in 2020, when the markets are looking forward to Union Budget a lot more. Many thanks for joining us.
Thank you.
Ladies and gentlemen, we're going to take a short commercial break.